Dividend ETFs are becoming more popular these days. There are quarterly dividend ETFs in the market, such as VOO and SCHD. But monthly dividend ETFs are convenient for managing cash flow and easy to budget. In this video, we will introduce the top 5 monthly dividend ETFs with high growth. And we will see how much a $10,000 investment will reward you. In the end, we will show you one ETF that can potentially make you over $600,000 and bring in over $10,000 per month as dividend. Number 5, we have JP Morgan Equity Premium Income ETF, ticker symbol JEPI. A regular dividend ETF only earns share price appreciation and dividends, but JEPI also does call options to increase dividend income. Here is how the fund invests. 80% of the assets are invested in 134 S&P 500 companies. The rest of the assets, about 10 to 20%, are investing in equity-linked notes by trading call options. This is to predict where the market would go in the near future. 80% of the assets are investing in technology, healthcare, industrials, and financials. Fund managers are actively managing the fund based on the market situations. Make sure the performance matches the S&P 500. Each stock takes no more than 2% of the portfolio. The rest of the fund is in trading call options. This is how call options work. If the market goes the direction as the fund manager expects, the fund will get a return called premium. This amount will be distributed to the investors as dividends. Usually, covered call ETFs sell the stock right away when the stock price hits the strike price, like QYLD or XYLD. Now, JEPI takes a slightly different approach. They are selling the stock above the strike price. It is up to the fund manager to decide when to sell. The further above you sell, the lower the premium you receive. This strategy allows the fund manager to maximize your return based on the market situations. By combining holding regular stocks and trading call options, the fund can maximize returns and minimize volatility. The current dividend yield is 6.44%. Since this fund is very new, there isn't sufficient data to make a reliable long-term projection. For a $10,000 investment, the dividend after 1 year would be $644. This is higher than most dividend ETFs. Since the fund's holdings are selected from the S&P 500, it is expected to experience positive growth over the long term. Number 4, we have Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD. This fund specifically targets stocks within the S&P 500. Out of these 500 quality stocks, the fund manager picks 75 stocks with high dividend yields, and then remove about 25 stocks with excessive volatility levels. At the end, it assigns a percentage of each stock based on the dividend yield. Stocks like Ultra Group, Kinder Morgan, and AT&T are the top 3 holdings because their dividend yields are very high. Ultra Group has a dividend yield of 8.52%, Kinder Morgan 5.81%, and AT&T 5.80%. Based on the selection criteria, we can see the fund focuses on low volatility and high dividend yield. So the top 4 sectors are utilities, consumer defensive, real estate, and energy. Usually, most ETFs like to place these sectors at the end and assign much lower weight. This fund does the opposite. Technology, industrials, and financials that have higher return and volatility are assigned to a much smaller portion. The current dividend yield is 4.19%, and the dividend growth rate is 5.8% per year. In the past 10 years, the share price appreciation is 3.6% per year. For a $10,000 investment, the investment would grow to $20,228 with an annual dividend of $1,034. In 20 years, the investment would become $49,059. Now the dividend is $3,018. In 30 years, the investment would be $134,361 with an annual dividend of $10,582. By reinvesting the dividends back to the ETF, it helps the stock to grow faster in the long run. Number 3, SPDR Dow Jones Industrial Average ETF Trust with ticker symbol DIA. Obviously, DIA tracks Dow Jones Industrial Average. For any stock that makes it to the Dow Jones Industrial Average, it must be actively involved in the U.S. economy and listed in either NASDAQ or NYSE. Consequently, these companies are typically well established with stable operations. Investing in the DIA, it's considered low risk, making it an excellent choice for investors seeking stability and minimal risk exposure. DIA is a price-weighted index, which means a stock with higher price will be assigned more weight than a stock with a lower price. For instance, United Health Group is trading at $509 per share and Microsoft is $447 per share. So United Health Group comprises 8.80% of the portfolio versus Microsoft only takes 7.21%. Here is a list of the top 10 holdings. They are all known brands in the US. United Health Group is a multinational health insurance and service company. In 2023, it ranked the 11th largest company in the world by revenue. Microsoft is also a well-known company that produces software products like Microsoft 365 and Edge web browser. The company also actively participates in AI powered by Azure to improve productivity. Goldman Sachs is a leading global financial institution, provides financial services to large and diversified clients, including individuals, companies, and government. The current dividend yield is 1.75%, and the dividend growth rate is 6.99% per year in the past 10 years. The share price appreciation is 8.70% in the past 10 years. For a $10,000 investment, the portfolio would become $24,234 with an annual dividend of $363. In 20 years, the investment would become $63,361. Now the annual dividend is $799. In 30 years, the investment would be $162,385, and the annual dividend is $1,723. The last 3 ETFs are good, but the next 2 are even better. The one ETF at the end can potentially make you over $600,000 and pay you $10,000 per month. Number 2, we have Wisdom Tree U.S. Quality Dividend Growth ETF, ticker symbol DGRW. This ETF invests in dividend-paying companies and exhibits growth characteristics. Although the dividend yield is relatively modest at 1.61%, the ETF has shown impressive growth, with a share price increase of 165.52% in the past 10 years, indicating a strong growth potential. This ETF comprises 301 holdings in 11 sectors, with technology, healthcare, industrials, and financials making up the top 4 sectors. Technology, healthcare, and financials are the primary drivers of the fund's growth, while the rest of the sectors provide stability through substantial dividends. The top 3 holdings are Microsoft, Apple, and Broadcom. They are participating in the growth of AI with actual products rather than concepts. Therefore, companies like that have a solid growth in the past 2 years. Same for NVIDIA as the 5th largest holding. In the past year, DGRW has had amazing growth of 19.05% on the share price itself. The expense ratio is 0.28%, higher than some dividend ETFs, but still acceptable. For investors looking for growing wealth with some passive income, DGRW is an appealing choice. The current dividend yield is 1.68%, and the dividend growth rate is 9.89% per year. The share price appreciation is 10.26% per year in the past 10 years. For a $10,000 investment, your portfolio would grow to $27,543, and the annual dividend is $448 after 10 years. In 20 years, the investment would be $84,466. Now the annual dividend is $1,323. In 30 years, the investment would be $257,689. At this point, the annual dividend is $3,888. As you can see, the dividend growth is much slower than the share price, but it still provides investors some passive income. Number 1, we have Invesco High Yield Equity Dividend Achievers ETF, ticker symbol PEY. The ETF selects companies that have increased dividends consistently over time. Unlike many ETFs that offer around 3% dividend yield, PEY stands out with a substantial 5.14% yield. The fund is heavily concentrated in financials, utilities, consumer defensive, and healthcare, which are known for providing higher dividends compared to others. As for the growth, it is not so much. In the past 10 years, the fund only grew 53.44%, while some other funds are able to provide higher growth. The tech sector has experienced high growth in recent years, but it only has 2.87% of the portfolio, so the impact is very minimal. There is always a trade-off between high dividend and high growth. If one gets higher, another one has to be lower. Also, we can see there are no REIT or limited partnership companies here, which is a good thing. These assets are taxed as regular income. It is higher than regular dividend stocks. The current dividend yield is 5.14%, and the dividend growth rate is at an impressive rate of 9.28% per year in the past 10 years. Therefore, the share price appreciation is a bit lower at 4.37%. This is not so high, but reasonable. In 10 years, we would see the portfolio grow to $24,846 and the annual dividend of $1,966. In 20 years, the investment would grow to $94,335 and the annual dividend is $12,055. In 30 years, the investment would be $601,632. Now the annual dividend is $124,161. Each month, the dividend is $10,346. As we can see here, reinvesting dividends back to the fund can also make the ETF grow fast, despite the share price appreciation being not so high. These are the top 5 high-growth monthly dividend ETFs. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.